schools of investing: fundamental analysis, quantitative analysis. I'm sure many of you finance majors have heard these terms before. We're going to quickly go over them for the people who may not know. So fundamental analysis, you would think of Warren Buffett. Warren Buffett is a value investor. He takes companies that he deems underpriced, invests in them, and sells them when they meet his price target. And that's a gross oversimplification of what he actually does. But just keep that in mind. Warren Buffett, value investor. Do you know who this lady is?
Oh,
Close.
she runs a ETF, right?
Yes, yes, good.
It's Cathie Wood.
Kathy Woods, exactly.
Yeah.
She runs ARK Growth Investments. And so she's kind of the counterpart to Warren Buffett, but they're both fundamental analysts. Well, they both subscribe to the fundamental analysis kind of investing. She is a growth investor. She takes really nascent, meaning really companies in their infancy, almost like a venture capitalist. And she takes she looks into sectors that have promise, like AI. She did some Neuralink kind of fields. And these are companies that may not have the cleanest financials. Like Warren Buffett wouldn't touch any of these stocks with a 10-foot pole. But Cathie Woods, she sees the potential. So Warren Buffett, value investor. Cathie Woods, growth investor. I promise this will make more sense later. So that's the first half of kind of investing in Wall Street. What's the second half? You have quantitative analysis. So quantitative, that means numbers. That means math. But what does this mean in respect to trading? So the first company that comes to mind is Jane Street. You might not have heard of Jane Street. They're kind of new. But what they are, they're a really big market maker for the NASDAQ. Basically, a market maker is a company that just puts huge buy orders and huge sell orders in any given stock. And what they're doing is they are providing liquidity, meaning that anytime you want to trade the stock, you're probably buying or selling to Jane Street. Now, of course, they're making money off of this. As for example, if let's say, not a great example, but for the sake of argument, Apple's let's say it's like $350 per share. It's probably not. I'm just guessing. So they would put a sell order at $351 or a buy order at $349, right? And so every time there's a buy and sell, they're making it $2 different. That's called the spread. Oh, and how does it relate to quantitative analysis? Well, they need quantitative analysis traders to kind of figure out which stocks need this liquidity, and as well as they don't want to lose money in this. What they're doing is they're putting just huge buy orders, huge sell orders. They can lose money too. If the stock goes really one way or another, they're losing profit. So they need kind of quantitative researchers to tell them, okay, this stock is probably going to shoot up. We need to pull some sell orders in order to not lose money. It's pretty complicated stuff, but maybe you've heard of this company, maybe not. Citadel. I see a few nods. So Citadel is kind of a group of hedge funds. In the industry, they're called pod shops, and these pods are kind of like they operate. They have like $1 billion or several $1 billion funds that are operated by a few highly intelligent, sophisticated individuals. And so they are big on quantitative analysis. They hire engineers, mathematicians, and so on and so forth to kind of quantify a stock. And what I mean by that is, everything a stock does. Like, for example, again, Apple, right? They have their strengths. SWOT analysis: strength, weakness, opportunities, threats. You can quantify this, and that's what they do. And they plug it into a mathematical model, and they use this model to kind of predict where the price will go. So the thing about quantitative analysis is it's very industry specific and it's very secretive. A lot of these companies, especially Citadel traders, if they let everyone know their secret, right, that kind of dries up the profit that they can make. And it's not so much secrets, and also these strategies, these models they come up with, they don't work 100% of the time, and they don't work always. Eventually the winds will change, and the model they've created, it's not gonna work anymore. So the sooner other people find out what they're doing and kind of replicate what they're doing, the sooner they're no longer gonna be profitable. So, but don't worry, I will share some of their secretive ways with you guys tonight, or today. Not all of them. So, we're gonna start with what's most relevant for this stock trading competition, and is what I used to kind of get a high placement on the last competition, the Bloomberg competition. It's fundamental analysis. So, for stocks to be specific, because you can analyze so many things, right? You can analyze bonds and whatever. There's 6 really important things that I want you to look at for any stock, really, and these are just the bare minimum. So, price, shares outstanding, market capitalization, value of the company, their cash, the company's debt, and lastly, enterprise value. And I'm sure most of the finance and accounting majors among you would know most of these. But what about enterprise value? I would wager maybe not so much. But if there's one thing I want you guys to take away from today, it's enterprise value. And I'll explain why. So price. It's pretty self-explanatory, but you'd be surprised how many people get confused on what exactly a price of a stock is. So it's the price of one share of that company, right? I think that's pretty self-explanatory, but there's something called the last price principle. The last price principle. Can someone give me just one company, just any company on the stock market? Throw it out there. Tesla, right. So we're gonna do the sophisticated method of just Googling it. Tesla stock. Thank you, Google. So 191.97. This is the last price, the last share the market traded Tesla. So the stock market closes 4 p.m. Eastern, it's 3 p.m. Central. So at 3 p.m., that last share, what was the price? 191.97. And again, you'd be kind of surprised, like how many people get caught up in what a price is. All right, shares outstanding. Shares outstanding. This is the second thing you want to look for. Shares outstanding. Just really quickly. So, can anyone tell me what that means?
Shares outstanding is how many shares that companies have that are owned or people already own them.
Yeah, basically. Yeah, it's all the shares the company has issued so far. And so, if we take a look at Tesla, let's look at their market watch. And this is an okay website. I don't want to endorse this website because there's a bunch of ads, but for the sake of this class, Tesla. It has some pretty good information. All right. So you see it has 3.18 billion shares. 3.18 billion shares outstanding. And I want to mention one thing. It's not to be confused with a float. And with fundamental investing, you don't need to worry about a float. But what a float is public float, 2.77 billion. What a float is this is shares outstanding minus the number of shares held by company executives, insiders, basically shares on the open market. These are the shares that are being traded back and forth right now. So a lot of these shares, they're held in stock options to incentivize the CEO to, it's actually quite interesting. So it's actually.
So is the shares outstanding minus the
The number. The float is shares outstanding minus the number of shares held by executives and insiders.
So how do we know that number, the executive?
Well, you can calculate it yourself looking at sources, or you can just look at public sources like MarketWatch. Yahoo Finance is another one. Google Finance as well. I'm just using MarketWatch because I'm just kind of familiar with it. Kind of interesting. Tesla's public float is actually quite big, so kind of shows you the governance style at Tesla. Anyway. Market capitalization. All right. So let me quickly. So we used Tesla. That's actually quite a tricky. Sweet. We determined that their price is $191.92. Yeah, it's changing a little bit because MarketWatch captures after-hours trading, but that's not really relevant. $191.91. Okay, please don't change. Shares outstanding. 3.18 billion. It's a large number. We'll do in millions. So 3.18 billion is 3,180. What's their market cap? So a market cap is kind of what a company is valued by the market. And it's pretty easy to calculate it. It's shares outstanding times the price. And this is kind of what theoretically, if you wanted to buy a company right now, how much do you need to cough up? Not really, but for the theoretically, kind of yes. So that's just price times shares outstanding. And that is, what is that? $610 billion, because remember, this is in millions. So, is that right? More or less, 628.
Plus it went down a little. So.
Oh, did it? Okay. So anyway, so that's all and great, but let's get into the real meat of it. Oh, and one more thing. So before we go ahead. So the SEC filings. So what I really want you to take away is there is one website in particular that I think you should all be familiar with when it comes to this competition, as well as in personal investing. And it is my favorite website, sec.gov. Yes. This is the #1 website for fundamental analysts. I promise you, it really is. A lot of hedge fund traders have this as their homepage, in fact. So let's go back to our example, Tesla. We can just do company filings. You can also search it in this box here. But Tesla. And we want to go to 10K, 10Q. So what are we doing here? So a 10K, this is the company's annual report for their fiscal year. And fiscal year just means a non-December 31st ending year. Some companies, the way they do business, it doesn't make sense for them to conclude their earnings report at December 31st. Sometimes they want to do February, depends on their industry. But it just means annual report for the fiscal year. An 8K is a quarterly report. So you have the 10K and the 8K for American companies. If it's a foreign company listed on the American Stock Exchange, there'll be something called a 20F. And that's what you'll look for. So, what's inside the SEC filing? Well, it's something I like to call the accounting holy trinity. And if you are an accounting major or you took financial accounting, you would know that there's really three things in a financial statement. It's the balance sheet, income statement, and statement of owner's equity. In some circles, they call this the book value. So going back to Tesla, let's look at their latest report, and that would be their 10K. And so you see that their fiscal year ends December 31st. So they have a pretty standard fiscal year. If you look at Coca-Cola, it's like February or something. Or you look at Walmart, maybe something else to account for Black Friday sales. Anyway, so the first thing, in fact, the most important thing for this class is we want to look at something called the consolidated balance sheet. So Control F. Balance sheet. Consolidated balance sheet. And so here it lists, if you take an accounting, you know this, assets, liabilities, equity, right? And so assets minus liabilities is equity. And that's a good accounting formula to know. But what about for investing? All right. So the third thing we look for is cash. What is cash? So when investors look at a company for its cash, it's not just looking for just paper money or just money in their bank account. It's looking for anything, any value with liquidity. Any value with liquidity. So what does this include? This includes cash, obviously, but also cash equivalents. Let's look at Tesla again. So what does Elon Musk have in his coffers? So current assets, we have cash and cash equivalents. This is in millions, so $16.4 billion in cash. Let's go back. So 16 point 16. Let's do the million. 16,398. They also have short-term investments. This can include, stocks, maybe bonds. It's something that is short-term. It doesn't really matter short-term. It just means something that they can just get rid of tomorrow. So if you were to buy a Tesla today, you are entitled to everything on their balance sheet, everything. And so if you can just sell everything with liquidity, get as much money back as you can, right? So anything you can sell tomorrow counts as cash. Short-term investments, probably stocks, you can sell them pretty quickly, right? It's not hard to sell a stock. I would count that as cash. So $12.7 billion worth of short-term investments. Accounts receivable. If you are an accounting major, you are very familiar with accounts receivable. Accounts receivable is basically money that their customers owe them. And is this cash?
No.
No. Very good. Yeah, it's not cash. Not really. Accounts receivable, they'll pay you when they pay you. You can't demand your money tomorrow because you can't access this right away. It's not cash. And the reason why it says net here, this means net of bad debt expense. And so companies, and this is just a quick aside, but companies like to calculate how much they expect their customers to just not pay off what they owe. And so this is what, after that calculation, they expect to receive $3.5 billion. So what else is cash? Inventory. Inventory may or may not be cash. Again, refer back to the principle, can you sell it tomorrow? Prepaid expenses, like prepaid insurance, prepaid rent. Can you sell that? No, right? Vehicles. Can you sell a Tesla tomorrow for what it's worth, for the book value? Could you just sell it tomorrow if you had it? Maybe. Maybe. What about their whole warehouse all their warehouses all over the U.S. Right? Well, maybe, right? If you're a really good salesman, but again, probably not. Solar energy systems, solar panels. Can you sell them right away? Probably not. Property, plant, equipment, digital assets. Maybe, right? Digital assets are kind of like stocks. You can sell them pretty liquidly. I would count that. 184 million in digital assets. Intangible assets, that's like patents,
Copyright is trademark.
thank you, copyright, trademarks. You can't really sell that, right? That protects your business, but you can't really sell that. Goodwill, right? Goodwill from suppliers or other companies. As you can see, that's kind of it. So, what does Elon Musk have in Tesla? Oh, oops. Equals sum. Right. So, $29.3 billion in cash. So, what does this mean? If you bought Tesla for $610 billion, okay, my numbers are wrong. Okay, that's fine. Okay, that's $610 billion. You coughed up $610 billion, you kind of get a rebate of $29 billion because that cash belongs to you now. You own this, you own the company. So it's not really $610 billion, it's $580 billion. Not that great of a discount though, but that's not all. There's something called debt. So debt is, what is debt? First of all, it's not a bad thing. You might expect, as a personal, just a common non-corporation like myself, debt is not that great. Credit card debt especially is a huge liability on your, financial health. But for a company, it's completely different. See, a company, they can borrow at very low interest rates, and they use this debt to do acquisitions, to make investments, to build more property, more plants and equipment. In fact, I would expect a company that's growing to have a lot of debt. So again, it's not necessarily a bad thing. However, when you buy a company, you also acquire its debts. So, let's look at Tesla's debts. It's under liabilities. Accounts payable, that's definitely debt. That's the definition of debt, right? Accounts payable is money you owe someone else. So, $14.4 billion. Accrued liabilities and other. In this case, accrued liabilities. To be honest, for Tesla's case, I'm not really sure. Like I said, Tesla's not it's not necessarily a small company. But we'll count that as a debt. That sounds like debt to me. 9080. Deferred revenue. Does anyone know what deferred revenue is? Do you?
It's like let's say I pay you for a service like $10, but over the days you only acquire like $1 because you still haven't acted on that service yet.
Yeah, basically. I mean, very close. It's much more simple than that. It's basically, money that you've acquired, but you haven't delivered the product or service yet. So, and that most certainly is debt because you owe, right? You now owe this much to someone. You haven't done the work. You haven't, right? Basically, that money is basically a loan, pretty much, until you've done that work and settled the score. So deferred revenue, yeah, of course, that's it.
It's kind of like when people do what is it called, when you pay in advance?
Yeah, exactly. Yeah, advance payments basically. That's
That was,
kind of like that, right?
It's kind of like subscription models when you pay like for the full year.
Yeah, exactly. Yeah, these are all great examples. So I'm glad you guys are getting deferred revenue. So yeah, $2.86 billion in deferred revenue. What else is there? Current position of debt and finance leases. Finance leases. Ugh, the car industry. I can't tell you because I don't know specifically what Tesla considers this. What's a finance lease?
Don't they
It
have-
could be like the robots
The robots. Oh, like
in a plant, like equipment in the plant
Oh,
on lease.
like another company produces that and they're leasing that. Sure, I think that's a good explanation. Yeah, we'll consider that debt.
They don't have like a page like right after this that has like an axis. I mean, not like an axis, but it just tells you like the cost or like stuff associated with the price.
Like a more like
Like a more in-depth analysis and just giving you a number, like telling you what's like the meaning
Oh.
behind the number.
not really. That would be like company specific. That's like their right. There's internal and external accounting. That's like their internal accounting, right? And so you're not getting everything, but everything they're including here is just the bare minimum that the SEC requires, right? So this is GAAP standard accounting, created by an association called FASB, which is the Federal Accounting Something Board. I forgot. Standards. Yeah, thank you. Yeah, Standards Board. So yeah, and so they're just doing the bare minimum really, because they don't want their competitors to know everything. But as an investor, they have an obligation to share these things, because if you own even one share, you're considered an owner of the company, and it's kind of it's kind of not conducive to be an owner of the company if the manager of your company doesn't share anything with you. Right?
So these companies put their companies up for stocks, or like if you own a company in the US, your company is automatically a part of the stock market?
So a company is not automatically a part of the stock market, but there comes a point in time where I think most ambitious companies with a lot of capital, but they're growing, they're pretty big, and they want more money. Basically, they want more investment. They do something called an IPO, and I'm sure a lot of you know what an IPO is, but for the sake of this lecture, an IPO is when they approach an investment bank. Let's say Ray's Muffin Shop. I'm now growing in size. I now have multiple muffin stores all over Texas. I can approach like JP Morgan and say like, hey, I want an IPO. They can, I don't want to get into this, but they do something called underwriting, and basically they can take my shares, sell it to brokers, and those brokers will sell on the open market, and that's called an IPO. And from then point on, it's now on the NYSE or NASDAQ, and then just everyday people like me and you can just go ahead and buy it. And it's just that's kind of the procedure. It's the IPO. Boom, the IPO happens. Now we can buy shares of the company, and now we can own the company too. So even if you own one share, you are an owner by law. Anyway, so I promise this will lead to something interesting. So, cash. 29 billion, debt, 28 billion. So remember, when you buy a company, you take on its debt as well as its cash. And Tesla, they're about kind of almost even, right? A little bit more cash and debt. So we figured out these 5 things. Again, don't trust the market cap. I kind of I kind of made a mistake there. Anyway, so we had these 5 things. The 6th thing is the one I really want you to take away from this seminar, and I feel like it's the most important thing. And it's something that's not really talked about in a lot of finance classes. It's enterprise value. Enterprise value, in a nutshell, it's enterprise value equals market cap minus cash plus debt. And I wrote here, it's how much a company is really worth. So again, going back to my example, if you buy a company, you acquire its cash, you acquire its debt. What's left over? That is your enterprise value. So market cap. It is not this much. It's actually 610 billion. I don't know how I got that. Anyway, it's 610, roughly speaking, billion. One. So that's 610,000. In millions, that's billion. Okay? So EV, enterprise value. So the equation is you're taking market cap minus cash plus debt. $609 billion. So if you want to buy Tesla, this is the real cost of Tesla. It's not a great example because that's an extremely high enterprise value, I can just tell you from experience. So this kind of implies that Tesla has a lot of investors in it that have pushed the price up so much that it's now worth $609 billion. So,
I don't like it.
hmm?
No one could really like buy it. That seems like.
Oh yeah, it's definitely out of range for, I mean, let alone regular people, like hedge funds, like, how would you even acquire this company, right? You kinda can't.
It's like the #1 energy stock
Yeah, exactly, you know? It's,
by cap.
yeah, exactly, it's truly a leader in not just automobile, it's really just, it's a leader in so many industries. They're doing solar and now AI, there's so many endeavors they're taking part of. Anyway, it's kind of ruining my example because that's really high. Anyway, let me give you a better example. So, with everything I just explained so far, let's see if you can kind of answer this question. So let's say Ray approaches you to buy his company, Ray's Stock Trading Co. He tells you he wants $10 million for this company and that the business generates $1 million in net income annually. You check his company's details and notice it has $7 million across several corporate accounts and no debt. I don't take a lot of debt. I don't like that. Would you take this deal? Just throwing it out there. Just from this information I gave you, would you say this is a good deal?
Yes.
Yes?
Oh,
Yes.
I think.
Gotta think? That's smart. Gotta think about this. Gotta think about anything that involves several million
I'll
dollars.
say no, because it's over several corporate accounts. Maybe that's probably what I would take.
That's a great answer, you know? You gotta be you gotta scrutinize every single detail.
Isn't that normal though? To have multiple corporate accounts?
That's relatively normal, but you know, I'm just, you know, trying to get,
There's too many. It says several, like, when they mean several, they mean a lot. So if you have 1 million a year, how long has it been like running? If you make 1 million, how long has it been running? And if you only have $7 billion and it's been running for about 10 years, is it really worth it? That's all I think. Maybe.
yeah, no, that's a great way to think about it, you know? And, I mean, you'd be a great, you know, investment banker because that's the questions you need to ask. Sometimes it's not just the book value. Sometimes it's not just the financial statements. You need to know a lot more about the details, right? Like,
They have to run it. $7 million and you've been running for 10 years, and you only 10 plus years or 12 plus years, you only got $7 million over several corporate accounts. That's not a lot.
suspicious?
Yeah.
Okay. Anyway, I mean, yeah, like I said, you know, you gotta really scrutinize the details. But for the sake of this example, and in the respect of the six things, right? You know, cash, you know, price, shares outstanding, market cap, cash debt, enterprise value. This would be yes.
Oh.
So if you calculate the enterprise value, right? So he's offering you, this loony guy is offering you $10 million for his company. This might change, but he's making a net income of $1 million. So whatever his business is doing, it's making a net of $1 million per year. But even accounting this aside, let's just calculate the enterprise value, right? He has $7 million in that company across several accounts, but you know, we'll not get to the details of how suspicious or unsuspicious that is. Right? Let's just say it has $7 million. You acquire that $7 million and you acquire all his debt, which is nothing. So you're coughing up $10 million to me. I'm giving you a company that already has $7 million inside. So you're really paying $3 million, right? Because you can sell that $7 million in cash equivalents, right? It could be cash, it could be cash equivalents, doesn't matter, right? You have that 7 million, you pay 10 million, you really paid 3 million. And this business is earning $1 million annually. And we're gonna, for the sake of the argument, we're gonna assume that this is a pretty reasonable amount that, let's say he's hired, professional traders and they make around this much, so you can expect that much. And so what happens is you can make that $3 million in 3 years, right? So in 3 years, $1 million per year, that's that other $3 million. So you're making back that money in 3 years. In Wall Street, and this is kind of an older rule, but there used to be a rule of thumb that if an investment can make back your money in 15 years, it's pretty decent. So this company, you're making back, yes, you paid $10 million, but the enterprise value, you really paid $3 million, and you're making back that money in 3 years. Do you take the deal? Yes. And poor Ray, he would, so to speak, he got hustled here, right? That's a pretty bad deal for me. So I don't know why I would do that, but anyway. So I explained all this to you, and it's like, you might find this boring, and I would agree. We're not doing anything exciting, really. But let's see this in action, right? So I pulled up, and this is just for, for the relevance of this discussion. This is an email I wrote last semester for the Bloomberg trading competition. And this just shows one of my better trades, and pretty much one of my best trades last semester. I sent a lot of emails just to document my trades, and for this one, I was looking at a stock called LIAN, Lian Bio. And so I did a quick financial statement analysis, just like the one I just explained to you. I looked at cash, debt, enterprise value, and they had a recent news of receiving $350 million for a deal. And this was cash, so liquid, right? You can sell it tomorrow. So this, I added that to their current enterprise value, and I got around $455 million. Or not enterprise value, I added that to their cash, and cash was $455 million. I erroneously said shareholders' equity. It's not, it was cash, basically. Despite this, their current market cap stands at $323.65 million. So my point was, they didn't have much debt. They now had cash equivalent of $455 million. They were selling on the market for $323 million. So that's a discrepancy of about $130 million. And so you can kind of calculate what the value difference of this new deal and their current price. And at the time, it was $3.02 per share. And I made a bold prediction that, if you count this 25% price differential and you apply it to the price per share, you could see that the new price would be, reasonably speaking, $4.24. And this logic is not, it's not really set in stone. The market decides the price, right? But if all else equal, it should be. If their treasury just gained 25% more cash and they have very little debt, you expect their price per share to also increase 25%. Again, all else equal, no severe market fluctuations. So what ended up happening? So this is on the Bloomberg terminal that all of your computers have, and it was around this time. So where my mouse is, oh god, I don't know if you can see it. It's really dim. But that was around midday of October 24th, and it was around $3. And that's when I read those financial statements. I was like, yeah, it popped from $1.50 to $3, and it's like, yeah, it doubled in price, right? It doubled in price, but the thing is, like, yeah, that's great, but here I am sitting on the sidelines. I did not invest in $1.50. If I invest at $3, what if it goes back to $1? I just lost half my money, right? More than half. So I looked at the financial statements. I was like, okay, with this influx of cash, I would assume that it would increase to like 420-ish. And again, I cherry pick my examples because this was a really good example of it actually working. Sometimes it doesn't.
You ever had invested to a stock and the opposite happened?
Oh, all the time. And I'll explain that, and I'll explain that in great detail because at the end of the day, the market decides what the price is. And in fact, some investors call it Mr. Market. They say Mr. Market will decide what the price is, and it's just to kind of personify the stock market because it's almost kind of like a living, breathing thing if you think about it esoterically. But anyway, so in this case, it was a pretty thinly traded stock, and the price kind of settled. It didn't keep it went up. It didn't keep going up, and I'll show you. I'll give you a better picture. LAN. I'm gonna look on Google. It's not 4.7, but don't look at this because they had another news report that kind of pushed them up. But so October 24th, right? So 302. I don't know if you can see that, but so I kind of wrote this email. And I did this analysis at 302, and I was like, hey, you know, Dr. John, I'm like, I think my next trade will be a long position, and my price target is 420 because I calculated the enterprise value, and I think it's a 25% revision upwards, and it went up to about anywhere between 403. And look at this, it was from the beginning of November, and all the way to next year, February 9th. It really fluctuated between 410 and like 418, but 420 was like the median. So again, I'm very egregiously cherry picking my examples, but just for the sake of this discussion, this is an example of when fundamental analysis goes right? And I was more or less spot on. It really trended around 420, and that was just purely from fundamental analysis, right?
So like, say if you're looking at a company and the trade market is 150, how would you know if it's gonna go up or not? Like, what would you look for to know if it'll be worth risking?
The what is 150?
Like, for example, you said this company started at 150, but you ain't know it's still in increase.
Oh yeah.
Right. So like, if you were to look at a company that was 150
Right.
before it hit 3, right?
Mhm.
How would you be like, okay, maybe I should like invest in this because of what would you look at to know that it's a good investment?
Well, there are some people who will know that the price will double in price tomorrow. Those are insiders, and there's something called insider trading, and it's something that the SEC takes very seriously. Because to know this, you would need that insider knowledge, or you just got to be really intimately familiar with the industry, and you would have to be an expert to such an extent that the majority of other sophisticated investors in the market wouldn't know. Because as soon as people get the wind that, hey, they're probably gonna get this $300 million cash deal, the stock price would have shot up immediately as soon as that was out to the public. Even if it was leaked, right? People would capitalize on that. So, really, I hate to say this, but there's really no way. Legally speaking, there's no way.
So everything you really invest in is a risk.
Everything you invest in, well, yeah, exactly, because there's no such thing as a riskless trade. Every trade has a risk.
Right.
I mean, if you're on the front side of news, but that news has to be not from a news source.
Yeah.
So there's no way you can look at their old stuff and be like, okay, if they've been going for the past 5 years, so maybe it's a good investment to probably do that.
I mean, some people certainly do that, right? They certainly, well, I mean, this is a quick aside, but pharmaceutical stocks especially, like the way that the kind of investing you're talking about is like, kind of like, I don't want to say this, but it's like kind of like gambling. Like you're throwing your chips at, stocks that might pop. And that's really popular with penny stocks and pharmaceutical companies, because these pharmaceutical companies, just out of nowhere, they can get FDA approval for their drug, and that guarantees that they can sell their drug, a patented drug, for as much as they want, and make tremendous amount of revenue, and their stock will just pop off. But you really don't know. And there are people better equipped to talk about pharmaceutical drugs than me, because I didn't trade them much. But I just know that that's just kind of a industry that you're probably describing, where it's like, yeah, you look at stocks that haven't really beat down, but they might pop up. They might get some FDA approval that would cause something like this, and that happens every day. Not every day, but like several times a week at least. And so yeah, that's certainly a style of investing. It is risky because they could stay in the gutter for years. You don't know. But yeah, some people do make money off of that. But for the sake of this competition, that's not feasible, right? Because we only have like 6 weeks. I haven't checked the time frame. I was like maybe 3 months, 2 months. I forgot. Anyway, so for the sake of the competition, that's not really viable. For the sake of the competition, what I did was I just took a look at the stocks that were already popping off, and then applying fundamental analysis and technical and quantitative analysis. We'll get to that later. But I applied my analysis to determine if they were going to go higher or going to pull back. For the sake of a competition, remember when I said there's like barbecue, backyard barbecue, competitive barbecue. What you're going to use in competition is not what you're going to use in your backyard. So backyard stock trading, competition stock trading.
Did you trade like any earning reports during the competition?
Earnings?
Yeah, did you trade any earning reports?
I'm so glad you asked that because yes, that's actually one of the strategies I'm going to touch upon about this competition, because for the competition, the greater the risk, the greater the reward, and you want to maximize reward. And nothing is riskier than earnings play. So earnings in trading is something we call a binary event. It's a really popular event where a lot of traders are going to trade this one event, and the stock is either going to go up or it's going to go down. And really, honestly speaking, it's pure gambling. You really have no idea whether after an earnings it's going to pop off or crash. But for the sake of a competition, it's not always a bad idea to avoid these. Personally, I would tell you to stay away. But for the competition, if there's a company like, for example, Apple, what if they have earnings season? I don't know if they do, but if there's earnings, and you're like, I think they're gonna kill it this time. Put $10,000 in my trading account, and let's see it go up.
So when you visited the competition last time, what was the company, you looked at the major companies first? Or did you look at, what company did you look at first that you invested in first?
Yeah, absolutely. Oh dear, I've been talking for a long time. Okay, I'll try to, I need to speed this up. But really quickly, yeah, we'll get to that.
Yeah.
And you know what, we'll get to that. We'll get to
Okay.
that, yeah. Don't worry. That's because that's a great question. And to answer your question, yeah, earnings is a binary event, either goes up or down. For the competition, yeah, if you feel like you have a good grasp of, you can predict the earnings. Honestly, no one can, but it's a good way to try. And besides, it's paper money, right? It's not real money. So I encourage you to do earnings plays, right? Put your money before an earnings, see if you can predict it. Okay, so to answer your question, we're gonna go to what aggressive, high-risk traders use for picking their stocks. You use a catalyst. A catalyst, it's any kind of news that causes a major increase or decrease in price. They include major changes in company financing, lucrative deals, analyst upgrades, downgrades, FDA approval, like I just mentioned, or acquisitions. Basically, it's just any news. For example, LIN, LianBio, their catalyst was they had a $350 million deal that caused a huge spike in price. So for the sake of the competition, we're looking at companies that have had this catalyst yesterday. So now what this means is that their volume is high, meaning that like millions of traders are now betting on this stock, right? They're either buying it or selling it or shorting it. But we want that high volume because that high volume is high volatility. And as for really day traders or people trading in a competition, you need volatility to win. So really quickly, how do I get this Catalyst. Well, I recommend finviz.com. So Finviz is free, and I use this a lot during the competition. And you can just pick any stock. Actually, no, even better. I'll show you what I really did, right? So you can go to Screener, and Screener is just a way for you to sort stocks for the day. And you can go to sort by change. So change is how much they moved today. So look at these, right? Sequence, pop culture group, down 43% today. You know, when you hear sequence, you think of nothing but quality, but I guess not. Or click it again. Wow. Ocean Biomedical, great pharmaceutical company. They probably got FDA approval, and guess what happened? Their stock went up 185%. That's almost 3 times. So $1.50. They must have been like 60 cents before, and they shot it.
Invested into that yesterday.
Yeah, exactly. It's like you look at all this. It's like if you had this information yesterday, you would have been a millionaire, but you don't. So that's kind of issue.
So you were like, basically, would it be a good idea to invest now since they're going up?
Well, that's the $1 million question, right?
Right.
That's where the fundamental analysis comes into play, and a little bit of technical analysis. And I know you don't know what that is because I have a slide coming up, but this is just to get a pool of stocks you're interested in. And again, please make sure you remember this is competition strategy. This is not what you should do personally. Oh dear God, don't do this. Yeah, because these are all volatile, and a lot of these are kind of penny stocks, and they're run by really the seediest CEOs you've ever met.
Yeah, corrupt.
Exactly. And so another trick you can do is this thing right here, float. I mentioned float earlier. Float is how many shares are on the open market, not held in executive directors in their own accounts. So this is a kind of a day trading strategy I used back in the day, like in 2016. But the lower the float, generally speaking, the more volatile the stock is, the more it can pop or crash. And the reason for that is there's less supply. It's basically the supply. The less supply, the more a small shift in demand can move the price. And so anything under 100 million is really a small float. So what you can do is even better. You can go to Finviz, Screener, sort by float, not sort, but do under 100 million. These will give you all the stocks that are going to be volatile. Guaranteed to be volatile, guaranteed. Not necessarily a good kind, but just volatile. And again, you sort by change. You do lowest, highest. And again, well, obviously, the biggest movers are going to be low float stocks. So again, Ocean Biomedical. I don't know any of these, right? Probably.
Carvana.
You see Carvana? Oh, look at that. I mean, there you go, right? Carvana. I don't know what happened, but low float. They're considered low float. They're $7.9 billion. That's interesting. That's pretty big for someone who's moved this much in one day. So they must have had a great catalyst, and we can check. So this is actually great example. So we actually know Carvana. Let's see what the catalyst was. So if you look right here, okay, I don't need this advertisement. Okay, you can kind of see that it's hard to see, but this was yesterday, just yesterday, when the price was like $50, and today it just popped to 69. So you see that gap? And traders call this a gapper. It's a gapper. You know.
You're the one doing that, right?
It means that overnight, some kind of news happened that at 8 a.m. opening bell, it went so high to the point that it creates a gap in the candlestick chart.
That's up 32%.
Yeah, that's crazy. I don't know what
Oh,
happened.
because they got their first annual profits ever.
Really, earnings?
Yeah.
Oh, wow.
Okay, well that ties into what I'm about to do. You scroll down on Finviz, the profile for the company, you scroll down, it'll tell you the latest news, and you can see, it even tells you what news correlated with that price increase. So it's like you said, analyst unveils new Carvana stock price target after earnings. Yeah, and I didn't plan this, obviously. I didn't even know until today, but it kind of ties in, right?
To the
analysts
front,
upgrade, downgrades, it's included, right? So analysts can really affect the price.
And see, like stuff like that, like if you just do a lot of reading, a lot of homework, like it's not a mystery that the car sales went up.
Yeah,
like,
I mean,
like from yesterday to today, like it's not like, oh, we just forgot we sold 5 million cars. Like that information's out there. You just gotta read and like research and think about. Like oil stock that I follow, one of the refineries went down, and then another one's under maintenance. So one went down unexpectedly, one went down for maintenance.
mhm.
He got 2 refineries out of 7.
Yeah,
Do you-
exactly.
Like, do you think their earnings is going to be really great, or probably not so much?
Yeah, it's like I said, there's two ways to kind of predict these, what traders call gappers, right? How do you predict a gapper? It's either insider knowledge or it's like I said, it's intimate knowledge of the company. But again, you gotta be like you know the industry, you know the oil, extraction industry. But like most people don't, and most people are not going to be really experts in the car industry so much that they can predict something like this. Because like I said, if the majority of people knew, or even not majority, just several sophisticated people knew, the price would have jumped yesterday. Why has it jumped today? Because the majority of people didn't know. But again, it's possible you can predict these if you have deep, sophisticated, intimate knowledge of the field. So I need to hurry this up. So anyway, what is all this? What am I going with those? So again, you're seeing a catalyst. So I showed you, you go on Finviz, you can sort by float, and you can sort by increase or decrease, and you can see stocks that have already moved. So we gotta trade stocks that have already moved for the competition, because these are stocks that are gonna have high volume. And now the $1 million question is, 69, is it gonna stay at this level? Is it gonna increase even more? Or is it going to decrease? Well, before we answer that question, just one more thing. So I called this a gapper because on the chart, there is a gap between yesterday's price and today's price. This is an upwards gap. But you can figure this out even before a gap happens. How? Pre-market gaps. Before the price even prints on the chart, the pre-market opens. So pre-market means it's a low liquidity third-party market that you can trade on. Very risky because it has very low liquidity. But oftentimes, if a news happened like yesterday afternoon or during the night, it's reflected in the pre-market. And so before the market opens, let's say you got your coffee, you're ready to make some money in the stock market. It's right. So for Houston time, the stock market opens at 8:30 a.m. So it's 7:30 a.m. You have your coffee. All right, let's make some money. What do you do first? You search for something called pre-market gappers. And this is really inelegant, but I just Google it. I don't have a sophisticated method for this. There are places you can get good pre-market gappers, but they all cost money. So I just stick with the free stuff. Let's look at the first website. And so it gives you a list of companies that have moved significantly before the opening bell at 8:30. So at 7:30, before the real market has started trading, you can already see interest. You can see buzz surrounding this stock. So I don't know what this is. Who cares? Intuitive Machines, Lunar. So before the market even opened, they were up 40%. So with this knowledge, you can, it's not an endorsement of whether it's a good stock to trade, but it tells you that this is what's hot right now. And again, backyard barbecue, competitive barbecue, regular investing, competitive investing, we're interested in high risk. So this is gonna be a high risk stock. Lots of volume, huge amounts of volume. It's up. We're gonna bet if it's gonna continue going up or it's gonna go down. Because the stock, the Howard Stowe University rules is we can't short. So we can only go long, and long just means buying. Traders have all these kinds of terminologies. But, so we can only buy. So, yeah, this may be a good stock to buy and hope that it will continue going up. Let's see if it did.
It's like you gotta be lucky.
Yeah, you gotta be lucky, right?
Doesn't sound right.
Well, you gotta be lucky, but there is some strategies after the buy, and we'll get to that. I know I've been saying that a lot because we're running out of time. Anyway, so that covers pre-market gappers, gaps that happen before the market opens, catalyst, I covered that, and compare the quality of the catalyst with the enterprise value, the before and after, just like I did with Lian Bio, right? So I figured that, look, I read the news, okay, they got a $350 million cash deal, okay, that's pretty good. What's their, so they already shot up. What's their current enterprise value post-catalyst? It's actually still kind of low compared to their cash balance. So I predicted, in this case, predicted correctly, thankfully, that's not always the case. In fact, that's very rarely the case. That it would go up 25%, and which it did. So, Dr. Dong.
Hi, hello. My meeting lasts longer than expected.
Oh, no, that's not a problem.
I am great to see many of you. I know it's Friday. So
Yeah.
Thanks for coming. Let me have a short introduction. I'm Professor Yi Zin. I'm the advisor for the Cancer Investment Fund. I'm a finance professor. So I was responsible for our investment programs. Okay, so thanks for joining. Are you all in the investment club? Okay, have you all signed up for the national, have you mentioned the national HBCU
Yeah.
challenge? This is the competition hosted by another HBCU schools. And then we have our students, since we use the same trading platform, so we have participated in the last few years. And our students did a fantastic job. Almost every year they are on the top placement. Okay? So I'm looking forward to this year. Maybe some of you will be the winner, and they increase the price significantly in these 2 years.
Yeah.
So it is a very rewarding competition. You are an experience, you may show off your investment strategy, right? And you may make some money.
Yeah, 12,000 cash prizes, that's not small.
And you might find a job.
appreciate, Ray has good leadership, he is a very experienced. He participated in the Bloomberg competition last semester. That is a global competition. And he lead the team, you are placed number 7, right?
7th in the
In,
US
in the,
and 15th globally.
I think it's the North America.
North America?
North America.
Yeah, North America. we did.
Including Canada, So
Yeah, oh, yeah,
we are
right,
so
right.
proud of him, and he has a lot of strategy you can steal. I wish I could.
Well, that's
So-
what we're doing.
Okay, thank you. So I will let you. Oh, just one more thing. Yes, they have the criteria to get the prize. So make sure you follow. I think one thing is they require you to have some minimum number of the trades.
40 trades.
Yeah,
We
and
went over
also-
that at the beginning.
Okay,
Yeah.
and because in the past I have some students, he ended up as a top position, but
Yeah.
very unfortunately they miss, those things and they didn't get money. So I think, okay?
Yeah,
Have
no,
a
yeah.
long meeting.
Yeah, no problem, no problem. Thanks for
Okay.
coming.
Good luck.
And and thanks for y'all for coming. I know it's Friday, so to sacrifice your Friday afternoon to come listen to me speak is I'm very thankful. So thank you. So anyway, yes, does the catalyst justify the new enterprise value? In the case of Lian Bio, no, it didn't. It deserved to be higher. That's not always the case. But this is just, and at the end of the day, all this is we're using fundamental analysis in competitive trading. That's what we're doing. And you can use fundamental analysis and passive your own like Charles Schwab and Robinhood and everything. But this is in a competitive perspective. But at the same time, you learn how to do it competitive, and then, you can take some, it's a good experience, right? It transfers over to your personal methods. Anyway,
And competitive just really means high risk, high reward.
precisely, yeah, I'm glad, like, that's really what I want y'all to get out of this, right? All it really means is high risk, high reward. So you learn what's really risky, so you kind of know what's not risky. Anyway, so that's all fundamental analysis. Finally, we're getting into quantitative analysis. And like I said, quantitative analysis is used by Jane Street, it's used by Citadel, pod shops, which are privately owned hedge funds, sophisticated investors. You're talking researchers that are paid $300,000 a year just to make these mathematical models. So what can I teach you guys? Well, admittedly, not too much. We're going to look at one quick formula, and this is something that I know for sure Citadel uses. It's called the Fama-French model. And this is something, it's really optional. I'm not going to get really into this. I'm really just showing you what these sophisticated mathematicians and engineers use at these multi-billion-dollar hedge funds. They're going to use something called a Fama-French, and this is just one of the many models they use, but this is a very classic one, right? And so it's the projected return of a stock minus the risk-free rate of return, and that is the interest rate of a 30-day U.S. Treasury bond. And if you don't know what I'm talking about, that's fine. It's actually supposed to sound more complicated than it is. And then you have equals I forgot what A is, plus a coefficient times something called the value risk premium, plus another coefficient times the size risk premium, plus another coefficient times the value risk premium coefficient plus error. And so I don't expect you to really know what this is. But if any of you have taken Principles of Finance, FINA 3310, I just want to quickly show you something. You may have seen something like this. This is my practice exam that I just literally took this exam on Tuesday. I took this exam on Tuesday, and one of the formulas we used was this formula to calculate the interest rate of a bond. And what is this? It's projected rate of return. Projected rate of return. And this is risk-free rate is on the left side. If you put on the right side, it's a plus, right? Plus RF. Nominal risk-free rate of return plus RP. What's RP? RP is 3 risk premiums: default risk premium, liquidity premium, and maturity risk premium. Risk premium, risk premium, risk premium with some coefficients, but that's to be expected. It's not going to be 1-to-1. My point is that you've already kind of used this. Many of you have taken FINA. You already kind of used these formulas before. It's not as sophisticated as it may look. We're not really going to get into this today. If you guys are really interested, maybe I'll have a seminar later after the trading competition, because Lord knows I took a long time making this. Anyway, so my point is that so a lot of these quant traders that are making $300,000 a year, they're using some fundamental finance formulas, right? Yep. Yeah, here, right? I just used this on my test on Tuesday, just to pass. Hopefully, I think I'm gonna get my grade back yet. Hopefully, I pass. Anyway, so we're not going to dive into that aspect unless you guys want me to later. So we're instead going to talk about something more relevant to the competition and more relevant to something you can do to win. It's called technical analysis. If you watched day traders, swing traders on YouTube, all they talk about is technical analysis. They talk about what's the trend line, what's the moving average, volume, SMA, simple moving average, EMA, exponential moving average, volume weighted average price, RSI, relative strength indicator, Bollinger Band, support resistance, and more. You'll hear all these kinds of terms thrown around. And I just want you to know, all this is it's technical analysis. And this is my definition, and other people will disagree, but I adamantly defend my definition. Technical analysis is using past human behavioral data to predict human behavior. You're using data from a chart. Let me quickly pull up Binance because I can't log into Bloomberg for some reason. And Binance is the only website I know that offers free interactive candlestick charts. So bear with me. I'm going to look up a cryptocurrency called Chainlink. And I don't endorse I don't endorse using Binance. I just use them because they have a chart and it's very fluid, interactive, and it's free, and you don't have to log in. So anyway, so just looking at this chart, you can see some lines. It's not just the candlesticks, and I'll get to candlesticks in a second, but the candlesticks represent the price. Anyway, you see these lines. You see this cyan line, this purple line, and this orange line. You know, so traders use this to kind of predict where the price will go. But you have to keep in mind, these are based on historical data that is influenced by humans. So we have let's see, what is this? The 99-day moving average. The purple is a 25-day moving average. The 7 is the orange is the 7-day moving average. And what I'm saying is not important. My point is that these lines are created using mathematical models that a mathematician have already made, and you're just overlaying on this chart. And you can, theoretically, you can use this to, let's say, I can use this line to say, okay, when the price touches this line, it's gonna support here, and I can take a long position and wait for a bounce up or something like that. And so you hear this a lot on the internet, and I just wanted to say that it's, at the end of the day, it's human behavior, because the market is driven by humans buying and selling. And so humans are irrational. So it's data that is not, that you shouldn't take these that seriously. That's what I'm saying. They can help, and I will mention some strategies that use these, but don't take them so seriously. But yeah, to sum up, technical indicators, you can overlay them on a chart. It looks pretty, but that's all they are. They're just kind of things you draw on your chart to reinforce your trading strategies. I'll get to that in a second. One really useful technical indicator is right here, volume. And you'll see this on Bloomberg too. It's usually bars at the bottom. Volume is just the number of shares being traded, either bought and sold at a particular time. And so the higher the bar is, the more volume during that time period. And this is relevant. I'm not a fan of these moving averages, but the volume I am a fan, because what this represents is you want to get in a stock that has high volume. So when it has high volume, that's when the volatility is high. So again, for competitive barbecue, for competitive trading, look for high volume. When the volume is high, your profits are none, so to speak. Right now, if you're looking at this cryptocurrency LANK, the volume is pretty low. There's nothing going on. This is not a hot cryptocurrency.
Excuse me.
Yes.
I do apologize.
Yeah, no problem.
I want to know, what is the website for me to sign up for the competition? Because I didn't get the link.
Absolutely.
And then, is there any way you could put me in the group me?
Oh, absolutely. Yeah. Right after this, I'm going to stay for a while. So, but
I have to go.
Oh, no problem. Let's see, you just Google it because this might be pretty quickly. HSSU stock trading competition. Will this show up? Wait, is it this one? Yes. If you just Google HSSU stock trading competition, it's the first one. It's on Stock Track.
Okay.
Yeah, and then you just sign up with your PV email address, and you're good to go. Yeah. Just be sure to sign up by midnight. That's the deadline. As for if you don't mind, because I don't have a pen with me, if you can just write your email, scratch a piece of paper, yeah, I'll email you and I'll invite you to the club. Our Millionaire Club. Not really. Anyway, so, oh dear, I'm taking a lot of time. Okay, I promise you I'll wrap this up. So lastly, these are lagging indicators. Again, they're using historical data. These can only help you give you an idea of what the price will be in the future. Yeah, just like over here. Thank you. You know, these don't predict the future for you. They just give you somewhat of a training wheel if you need it. Besides volume. And support and resistance are the real deal too, and I'll get to those in a second. But yeah, they're called lagging indicators because they lag behind the current price. Anyway, so what happens if all you do is technical analysis? Well, your chart kind of looks like this. You're drawing all kinds of things on your chart, and it just colors it, and it looks terrible. And this is not indicative of you making profit. This is indicative of you being a crazy person. So this guy, he's drawing like all kinds of these trend lines, and a trend line, all that is a few data points that make a line, right? You draw a trend line. He's drawing another one over here, and he's drawing all these support lines. He's drawing all these, like, I don't even know, all kinds of geometry. And if you are really into this, your chart will look like this. You can't even see. I've met many traders whose charts kind of look like this gobbledygook. And so my point is, technical analysis, it's not really going to carry your success. And it's just like I said, it's a training wheel if you need it. And I'll get into some technical analysis things that I use. Anyway, yes, you don't need this many trend lines. Some trend lines are okay, not this many. Okay, really quickly, I'm sure some of you already know this, but a candlestick chart. So the chart I just showed you, right, on Binance, the cryptocurrency exchange, they use candlestick charts, just like Bloomberg, just like everyone, right? What does this mean? Well, these are superior to line charts. I highly recommend that you at least can read these charts to a decent standard. They were invented by the Japanese during the time when they were really big on trading. Now not so much, but and it's an ingenious way to fit as much information into a chart as possible. And what this tells you, so one candlestick, it has a body and it has two wicks, and if it's green, the body starts in something called open, meaning that in any time frame. I know I'm using all these terms. I apologize for that. I'm going to go on Binance. I'm going to look at a 5-minute candlestick time frame. Okay, and so each candlestick represents a 5-minute slot in time. So right now, this candlestick is painting this picture. What this means is that 5 minutes ago, it started at, like, I don't know the price, it started here, and now it's here. But this wick, and this thin line is called a wick, like a candle's wick, right? It touched at this low point, but it went back up to here. And this is where the price is currently at. Green means it's gone up. Red means it's gone down relative to where the candlestick started and where it ended. I really hope that's an okay definition. I'm not the best at explaining things. But at the same time, candlestick charts are not too complicated. I promise you, if you don't really get this, the more you look at them, the more you'll kind of, it'll click, I promise you. But my point is, most traders will use candlestick charts, so will investors. It's standard for Bloomberg, it's standard for everyone. So yeah, compared to a line graph, if you were to look at a line graph, is there an option? They don't even give you an option. Anyway, So yes, they are superior to line graphs. That's kind of my point. Just really quickly, so how this applies to technical analysis, sometimes the way these form, they can kind of paint a picture, so to speak. And again, I would not depend on these pictures, but these are called patterns. And sometimes traders will refer to these as flags. And I'll give you a quick example. And again, like, I'm just doing this on the spot, right? I just opened this, this is the current price of LINK, and just right off the bat, let me see if I can identify a quick pattern. Nothing on the 5 minute. Let me look at the day chart. Okay, sure. We'll take this. We'll take a look at here. Okay. Can I make this bigger? No. Okay. So, are there any tools I can use? I don't typically draw on these charts, but okay. Yeah, I forgot how to do that. Anyway, I'll just rely on my own examples. So, I stole this chart from a trader on TradingView. I gave him credit, but you can't read the font, but I don't think he'll sue me. So one of these so-called patterns that traders will sometimes use, the most common one is called a bull flag or a bullish flag. So I'm not going to read his definition. I think I can offer a better definition. And it represents a stock price that has gone up, and this upwards movement. Let's say you missed it, right? Like you mentioned, ideally you want to get the stock right here, but that's probably not going to happen. You probably see the stock that's already gone up, and this is called a flag pole. What they call a flag pole is just a very vertical, obvious movement in price, a flag pole. And then this is called consolidation. And what really makes the flag is this consolidation area where traders are cooling down, right? This stock just jumped up like 25%. Let's take some profit, let's cool down a little bit. And so you get this consolidation here. And what many traders will do, they'll take a trend line and then take the low points of all these consolidating areas. They'll draw a line, take the high points, draw a line, and what you get is kind of a third grade drawings version of a flag. You have a flagpole and then the actual flag itself. And so what they're doing with this is this strategy is like this flag picture it paints. Traders will use this to determine where they'll take a position or exit a position. In this case, this trader from TradingView, and there's many different ways to trade these flags, but in this case, this guy is saying that, okay, I drew the flag. Let's say the price is like here. I'm going to take an entry at the bottom of the flag, the line we just drew, the bottom trend line. He's going to take an entry at the bottom. And if it goes to the top, he's going to add. And this is a very common strategy. When I was doing day trading, many people I knew also did this. And so the idea is, if it hits the bottom, he assumes that it has a likelihood of going back up. If it breaks the bottom, he's going to sell and take a small loss. No biggie. And that's a pretty good strategy as far as day trading goes. And the reason why he wants to, there's an entry too. The reason why he's adding again, right? You might ask, okay, if it's going to keep going up, like on this chart, why doesn't he just buy all his shares here? Why does he wait for it to go up and then buy again? Well, it's confirmation that once it goes up, there's a reasonable likelihood that it'll go further up. And if you buy it here and it goes back down, you can sell somewhere in the middle. And you basically, if it goes back down, you can just assume that, the breakout didn't happen. Breakout means another huge exponential movement upward. So if the breakout didn't happen, he can kind of sell in the middle for a break even, because he bought here, he bought here. So if you sell in the middle, it's a break even. You didn't lose money, you didn't gain money. It's all good. But if it works out and you buy here, it goes to the top, there's a breakout, you kind of almost double the money. If you don't really get what I'm talking about, it's fine. We're getting into the more advanced stuff now. And again, I can't reiterate this enough. These are all high risk strategies. With risk comes reward. These are all high risk strategies. But again, this is just an example of the previous slide, some flags or patterns that technical analysis traders will use. Oh, and last thing, a long wick. If there's a long wick, it just means uncertainty, because that means in one time period, the price has tried to go somewhere, and then, for example, in this candle right here, you see the body is kind of small, but the wick is kind of long. And all this means is that during this 1 day time period, so this represents 1 day, 24 hours, I think. So basically, the stock kind of did a medium minor crash, and then traders immediately bought it back up to the point where it opened here, it kind of went a little bit up, and then it crashed. And then sometime during the day, maybe during lunchtime, traders bought it up to the point where it just settled here. And by doing so, it created a red candle and a long wick. And if you really want to get into the candlestick cult, some people would call this a morning star or a hammer candle. Really, it doesn't matter. Okay, the last part of the seminar. Oh dear, I said this was going to be like 1 hour. It's already almost 2 hours. I really apologize. I thought I would be able to get by this faster. Okay, I promise this is the last part. So this is just an example of kind of a culmination of the things I just talked about. And this is something you can use for the upcoming trading competition. So this is a method of swing trading. A swing trade, all that is a multi-day trade. There's day trading and there's swing trading. In the rules, it says you may not day trade, so you can use this strategy. I call this the lazy method. There's no real title for this trading strategy. And so I'm not going to go over all this. This is me. I stole this slide from last year. I made this slide last year. And so I'm just going to quickly sum it up for time's sake. It's when a stock goes up in value, just like that bull, just like that flag or that flagpole. And so forget all that advanced analysis. This is like trading for dummies. A very easy but shockingly relatively effective way to trade. All you do is you wait for that price to go down to the halfway point of the first day's candle. I know that sounds confusing. I'll show you. Okay. The lazy method, visualize. So this is ticker CEI, something called Camera Energy. Not too important. I mentioned a catalyst. Again, you gotta have a catalyst. So check. We have a catalyst. We have a stock that has high volume. It has high volume. It has a catalyst. So it's something that as a competitive trader, you'd be interested in. So you have your eyes on this, right? And so it's kind of cheating because I have the rest of here. But let's say all you can see is this candle. I know it's hard to see, but all you see is this candle. A strategy you can do is wait for the price to go to the midpoint of this candle. The midpoint of this candle. So it's just showing that, again, a high volume confirms the catalyst. That news really was a shocker. So traders are interested in the stock. High volume. So right at the gate, meaning there's a small gap. So right as the opening bell rings, it pops out at 27 cents, while the previous was the last price principal, remember, was 24 cents. So how do you trade this? Well, instead of buying right from the gate, because you never know, it could crash. Who knows? In this case, it went up. But a safe bet is you wait for that first candle to print, meaning that first candle to conclude, and now we're on the next candle. And if ever that price goes to the midpoint where I circled that green circle, right? If it goes to the midpoint of the first candle, you have an entry, and it's a risk minimized entry. I'll explain why. And there's no such thing as a risk-free trade, but this eliminates some risk. So once you're in a position, you bought in this midpoint here. So there's either two ways the stock can go. It can go up or down. You know it's going to go up or down because there's high volume. If there was no high volume, it's probably going to just trend sideways, and that's not where you want to be. If it just goes sideways, you probably picked the wrong stock. But we're interested in high volatility, higher risk, high reward. So if it continues, great, hold on to it. It's going to keep making you money because you're locked in, and now you're just letting the other high volume, all these other tens of thousands of traders kind of push it up, and you're good to go. But what if you were not necessarily wrong, but what if it doesn't go the way you want it to? It goes down. Well, a good stop loss, and in trading, a stop loss is a point in the price where you get out no matter what. If you're long, you sell. You're out, you clean your hands, you're gone. You sell if that price goes to the bottom of the previous candle. And you do this because if it goes further down, it's most likely just going to keep going down. And at that point, it becomes a short play. And short sellers are going to be really interested in this stock. And you don't want to be the only long biased person in a pool of short biased people. And in trading, they would call this the bulls and the bears. You might have heard of it. The bulls want the price to go up. The bears want the price to go down. When the bears take over, very likely, and this is called a reverse, I forgot what they call it in day trading. It's called like a reverse day or something. When that price goes below that opening bell, that means that all the bulls were wrong. So that catalyst, high volume catalyst, were completely unjustified. The market has spoken. The bears won. It's going to keep going down. You don't want to be the only bull in a bear period of time. That's not a good idea. You want to be a bull in a bullish trajectory. Right? So, and this is just me telling my other teammates that, yeah, hey, again, you bought here. Yeah, you better sell here. It's really a bad idea to, if it goes down, don't hold it all the way down. That's not a good idea. I just explained that more. Again, I stole this slide from last year. And yeah, if it continues kind of going up and above your price target, really just hold it, right? Just hold it for a few days, right? Until you're comfortable selling. And if it ever goes down, don't be scared because you got that stop loss. You got that. If it ever crosses here, sell, wash your hands, go to the next trade. We have 40 trades for this competition. In stock trading, they say don't marry a stock, right? If that stock is not treating you well, leave it, right? So if you're bullish, it goes below that stop loss, don't hold, hoping that it'll go back up. Maybe in regular investing, you would do that, but this is competitive investing. For competitive investing, you cut ties, you wash your hands, you're out of the stock. But if it continues to go up, you hold it for something called a swing trade, a profitable swing trade. We did that a couple times in the Bloomberg competition. This is the last slide. So, really quickly, I mentioned all the things you should do. What should you not do? All right. Buying a stock that just had a huge sell-off, decrease in price. This is AKA catching the falling knife. This is applicable for competition especially, but also regular trading. Catching the falling knife, that means don't be attracted by a stock just because it had a huge red day. And let's go back to FinViz and sort by stocks that had a really bad day. Change, negative. All right, Sequins. Everybody loves Sequins. No. So would you invest in the stock? This is also a gap, but this is a gap in the downwards direction, right? You had a stock that was 260. It opened today at 120. And per the last price principle, the current price is 90 cents. Let me repeat that. Yesterday it was $2.60. It's now at 90 cents. Now, just asking you guys, anyone, would this be a good stock to invest in?
Should be.
Shouldn't?
It should be.
Should be? Well, the answer is, well, it could be, right?
But you know what happens tomorrow? Like what it said, just in the night.
Like, see, I would invest in a stock like this if it was more like Apple or Facebook, like a big fall. Like if it's a market leader stock that just tripped, it's gonna come back. Like you look at BP with the big oil spill,
Yeah.
it went back to half, but it's come back since.
The
But
answer
like
is
penny stocks, like $2 stocks, no.
Okay.
I mean that's a great mentality to have. Yeah, I mean the answer is there's no right answer. But for the sake of this competition, I want to say that it's leaning towards a definitive no. A huge sell-off, it's not guaranteed. Again, you are now in the bears territory. This is bear woods, right? Don't be the bull in the bears territory. It's not 100%, but it's now like really heavily down biased, and it's not a great. It's not. This is really not indicative of a good value. Like so.
I mean, it's like junk bonds.
Junk bonds. Yeah, exactly.
Like it might look great, but if it's a junk bond, it's a junk bond.
Yeah.
If it's a stock under $5 or $2, it's just junk.
Yeah, exactly. And we're looking, and this is a penny stock, right? So just like you said about a junk bond is a bond from a company that's probably not going to pay you back the money you owe, and a bond is just debt. So you borrow, so the company borrowed money from you, it's not going to pay you back. It's called a junk bond in that respect. They offer high interest rates, but
They go bankrupt.
yeah, you'll go bankrupt. And so much of this company, this is a penny stock. If you look at their financials, I don't even have to look. I can just probably guess. It doesn't look great. They probably have a lot of debt, and not the good debt where you used to acquire equipment and purchase companies. They probably have the bad debt, meaning that they just need money to survive, basically. It's just
And the CFOs are going to be thieves.
yeah,
Like they can steal you legally.
Wow.
yeah.
I've had it happen.
Yeah, no, you're absolutely right, because again, for these penny stocks, we're no longer in the lesson, but this is a great lesson I want to impart with you guys, because you guys are here. A lot of these small companies, right, they borrow money to keep themselves afloat. The only thing on the CEO and CFO's mind is just keep their job. They don't really care if that company is losing you, the owner, money. They just want to keep their dang job. And to do that, they're going to make really bad business decisions that hurt the company long term. A lot of these companies are called zombie companies.
And I almost guarantee they're insiding trading.
Yeah.
Yeah, exactly. And that's what I meant. Like these companies, they're run by the seediest people you'll ever see. So again, so sorry to go on a tangent, but yeah, it's not generally a good idea to find a stock attractive just because it went down. To go upon what Clinton said, yeah, if it's a market leader and it goes down, I would hesitate to say like yes, all in, because in the case that it's not a company, if it's company specific, I think that's a great case, right? If it's a company specific thing, like, oh, Apple just, like, oh, Bendgate, oh, their iPhone 13 is bending, wow, that's such a big deal. No, it's not. Their stock price might have a hitch. It might go down a little bit, or it's not even bigger, like a big supply issue or political issue. You know, they're positioned to recover, no problem. But at the same time, if it's like a major recession, like you're talking 2008 levels, then Apple might be in the gutter for like 2 or 3 years or even more. You never know. So I hesitate to say like that's always the case, but in generally, yeah, that's really correct. In fact, if you went to Mr. Bill Block's seminar, he's like, yeah, Apple, these big market leaders, when they crash.
I mean, Boeing would probably have that, like with the door falling off.
Exactly. I mean, what other
Does it make Boeing a trash company? No.
No, exactly. Yeah. Where else are you gonna get your planes? Yeah. So yeah, that's a great example, and I like that.
Is it kind of like Starbucks as well? With their political.
Yeah. Like yes, like political risk. They do something. That's also part of your SWOT analysis, right? They do something that you think is stupid, and it is stupid because it makes their stock price go down. Yeah, it really depends. Like if you, the chances are, like I don't think majority of people are gonna stop drinking Starbucks for some reason. So yeah, like that's a good example. They're a market leader. They have that. They're in that position. So yeah, now that's my last imparting piece of advice, and that's it. Any questions?
Can we have the slides?
Yeah, absolutely. In fact, I recorded this whole thing just so I can upload it, and so people who didn't come, they can get this too, because everyone's participating in the trading competition, right? Everyone's participating? Yeah. Yeah. And so I know people aren't gonna come because it's Friday, so yeah, I just wanna, yeah, thanks.
Like the best thing, have rules and trade your rules.
What about the video recording?
That's gonna be uploaded to YouTube. I'll share that on the group me. Alright. Alright, if that's it, again, thank you guys so much for coming.
Oh,
Yeah.
I think they were saying like, they were supporting the, I don't know who's in the law, the Israelites for bombing.
Absolutely.
Thank you.
Yeah, see you later.
It's whatever.
Really?
Yeah. And a lot of people didn't like, their decision on that, so.
Wow.
I'm amazed that they could take the sand like that.
So,
Did we?
said that you change the options, I don't know if you will just give us